Hi, and welcome to One Chapter Closer, the audiobook channel that helps you experience one chapter at a time. Whether you're here to relax, learn, or enjoy great stories, you're in the right place. Let's dive into today's chapter and take one step closer to the end of the book.
The Intelligent Investor: Timeless Wisdom for Navigating the Markets. Benjamin Graham's The Intelligent Investor is often heralded as the Bible of value investing. In this masterpiece, Graham doesn't just provide strategies for picking stocks. He offers a comprehensive philosophy for approaching markets with discipline, patience, and resilience. With practical insights and timeless examples, Graham's guidance is as relevant today as it was when first published. Let's embark on a journey through this groundbreaking work, exploring its principles, tools, and the transformative power of intelligent investing. The essence of intelligent investing. At the heart of the intelligent investor lies a powerful distinction: the difference between investing and speculating. Investing, Graham emphasizes, involves thorough analysis, prioritizing the safety of principal, and aiming for adequate returns. Speculating, on the other hand, is a gamble, a reliance on market whims and hunches. To illustrate, Graham contrasts two characters: the careful investor who researches a company's financial health and buys at a margin of safety, and the speculator who chases hot tips. The former secures steady growth, the latter often suffers losses. Graham's distinction is foundational, urging readers to commit to a disciplined investment approach rather than succumbing to speculative temptations. The core principle: margin of safety. The cornerstone of Graham's philosophy is the concept of the margin of safety. Simply put, this means purchasing securities when their market price is significantly below their intrinsic value. This cushion protects investors from errors in judgment or unforeseen market downturns. Consider Graham's example of the Great Depression, when countless speculators faced ruin due to overvalued investments. In contrast, those who adhered to a margin of safety were shielded from the brunt of the collapse. For modern investors, this principle underscores the importance of disciplined buying and avoiding overpriced assets. Mr. Market: A Lesson in Emotional Discipline. One of the book's most enduring metaphors is the character of Mr. Market. Graham imagines the stock market as a moody business partner who offers to buy or sell your shares daily. Sometimes, Mr. Market is euphoric, pricing assets extravagantly. Other times, he is despondent, offering bargains. The intelligent investor, Graham advises, should neither be swayed by Mr. Market's emotions nor attempt to predict his behavior. Instead, use his fluctuations to your advantage. Buy when prices are low and sell when they are excessively high. A practical example of Mr. Market's wisdom comes from the 1973-74 market downturn. During this period, blue-chip stocks like GE and Coca-Cola became severely undervalued. Disciplined investors who capitalized on Mr. Market's pessimism reaped significant rewards in the following years. This metaphor serves as a timeless reminder to keep emotions in check and focus on intrinsic value. Defensive versus enterprising investors. Graham introduces two archetypes of investors: defensive and enterprising. Each has distinct goals, strategies, and risk tolerances. Defensive investors. These investors prioritize safety and stability. Graham recommends a balanced portfolio of high-quality bonds and blue-chip stocks, maintained in a 50-50 allocation. For instance, a defensive investor might hold well-established companies like Johnson & Johnson or Procter & Gamble. Their focus is on preserving capital and achieving steady returns without constant market monitoring. Enterprising investors. These individuals are willing to dedicate time and effort to uncover undervalued opportunities. They seek out stocks trading below their intrinsic value, often overlooked by the market. Graham's own investment in Northern Pipeline, a company undervalued relative to its assets, exemplifies the enterprising approach. Through careful research and patience, Graham turned this discovery into a profitable venture. Inflation: The Silent Threat. Inflation, Graham warns, erodes purchasing power and can devastate unprepared portfolios. To combat this, he advises diversification across asset classes. Equities, while not immune to inflation, tend to offer better protection than fixed-income securities over the long term. Using historical data, Graham demonstrates how investors in the post-World War II era managed to outpace inflation by holding a mix of stocks and bonds. This principle remains vital today as inflationary pressures persist. The lesson is clear. Staying diversified and vigilant is essential for safeguarding wealth. Speculative Mania, a cautionary tale. Throughout the book, Graham cautions against the perils of speculative bubbles. He recounts historic episodes like the South Sea Bubble and the 1929 crash, illustrating how overconfidence and herd behavior lead to financial ruin. A particularly vivid example is Sir Isaac Newton, who initially profited from the South Sea Company but later re-entered the market during its speculative peak, only to suffer catastrophic losses. These cautionary tales resonate with modern examples like the dot-com bubble of the late 1990s. Investors who abandoned Graham's principles for speculative gains often faced devastating consequences when the bubble burst. The takeaway? Emotional discipline and adherence to fundamentals are crucial in avoiding speculative pitfalls. The value of long-term thinking. Graham's philosophy champions patience and a long-term perspective. He urges investors to resist the allure of short-term gains, which often lead to speculative behaviors. Instead, focus on steady, compounded growth over time. An example of this principle is dollar-cost averaging, where investors consistently buy stocks regardless of market conditions. By spreading investments over time, this strategy smooths out volatility and builds wealth gradually. Graham's emphasis on long-term thinking encourages readers to view the market as a marathon, not a sprint. Real-life applications, case studies. Graham enriches his lessons with real-life case studies. In one, he contrasts two companies, one with a strong track record and undervalued assets, and another with inflated valuations driven by hype. The intelligent investor, he explains, would favor the first company, focusing on intrinsic value rather than speculative appeal. Another compelling example is the rise of conglomerates in the 1960s. Many investors chased these overhyped companies, only to see their portfolios suffer as valuations plummeted. Graham's insistence on thorough analysis and skepticism toward market trends proves its worth in such scenarios. Lessons for modern investors. In the updated edition of The Intelligent Investor, financial journalist Jason Zweig bridges Graham's principles to contemporary markets. Zweig draws parallels between Graham's warnings about speculative mania and the tech bubble of the late 1990s. Overconfidence in companies like Pets.com led to catastrophic losses when valuations proved unsustainable. Zweig's commentary reinforces Graham's timeless wisdom, emphasizing the need for emotional discipline and adherence to fundamentals in today's volatile environment. Whether navigating cryptocurrency booms or meme stock frenzies, Graham's principles remain a guiding light. Building a resilient portfolio. Graham's strategies offer a blueprint for constructing a resilient portfolio. For defensive investors, he recommends diversification and a focus on quality. Enterprising investors, meanwhile, must commit to diligent research and seek opportunities in overlooked areas. A key takeaway is the importance of adjusting strategies to fit individual goals and risk tolerances. Whether seeking steady income or pursuing higher returns, Graham's philosophy accommodates a range of objectives while prioritizing safety and discipline. Conclusion: the legacy of the intelligent investor. The Intelligent Investor is more than a book. It's a roadmap to financial independence. Graham's principles of margin of safety, emotional discipline, and long-term thinking provide a foundation for navigating the complexities of the market. His wisdom transcends eras, offering timeless guidance for investors at all levels. As Warren Buffett, one of Graham's most famous disciples, aptly states, "Follow Graham, and you will profit from folly rather than participate in it." By adhering to these principles, investors can turn market volatility into opportunity, building wealth with confidence and resilience. This summary brings to life the enduring lessons of the intelligent investor, blending Graham's insights with practical examples to inspire disciplined and thoughtful investing. Whether you're a novice or a seasoned investor, the wisdom within these pages is invaluable for achieving your financial goals.
Thank you for listening to this chapter on One Chapter Closer. Congratulations on being one step closer to completing the book. Don't forget to check out our channel for more specially curated audiobooks. If you enjoyed this, please like, share, and subscribe to stay updated on new releases. See you in the next chapter.